Okay, let's dive right into this explainer and absolutely dismantle a multi-billion-dollar illusion. I'm talking about the 99% win rate crypto trading bot. Look, if you've spent literally any time on social media or encrypted messaging channels lately, you've definitely seen them. You know the ones, aggressively marketed dashboards promising these wild, exorbitant returns and near-perfect prediction accuracy. But instead of just taking their word for it, we're going to look at the actual empirical data and the rigorous math to see exactly why that pursuit of perfection is a total trap. And as you'll see, why a verified 58% edge is actually the true hallmark of a world-class trading system. To put this into perspective, the scale of this retail trap is staggering. According to the FBI's Internet Crime Complaints Center, Americans lost over $11 billion to cryptocurrency scams in 2025 alone. That is a brutal 22% increase from the previous year, and a massive driver of this catastrophic loss, the deceptive allure of perfect AI bots. Scammers essentially use the inherent complexity of artificial intelligence as this technological smokescreen. They use beautifully simulated dashboards that show continuous exponential growth, basically designed to completely bypass a victim's natural skepticism. But hey, what about beyond outright criminal theft? What actually happens when everyday retail traders try to use or build legitimate systems? Well, European regulators mandate that brokers transparently disclose retail client loss rates, and the numbers are honestly pretty brutal. We're talking between 67% and 81% of retail accounts consistently losing money across major platforms. For instance, 67% lose on eToro and a staggering 81% lose at IG Group. Throw in the hyper-volatile crypto sector, and studies show that 97% of retail traders lose money within just their first 3 months. Section 2, the trap of perfect backtests. So if the real-world failure rate is that massive, why on earth do these marketing dashboards always show perfect, exponential profit curves pointing straight to the moon? The answer lies in a fatal data science error known as overfitting or curve fitting. This happens when a machine learning model or a rule-based strategy is so excessively tailored to past historical data that it actually captures random market noise, weird bid-ask anomalies, and total statistical outliers. And the fatal flaw is that it mistakenly treats them as if they were actual structural predictive market trends. The developers essentially just keep tweaking the parameters until the strategy's hypothetical performance perfectly matches the specific, unrepeatable anomalies of the past. To make this concrete, think of overfitting like a student who, instead of actually learning the underlying concepts of a subject, just rote memorizes the exact answers to a practice exam. When they sit down for the real test with brand new questions, they fail completely. Or it's kind of like a boxer who perfectly choreographs a fight against a single past opponent's tape. Sure, they look absolutely invincible shadowboxing in the gym, but the moment a real unscripted challenger steps into the ring, which represents live, unpredictable market data, that rigid training just results in a devastating knockout. So whenever you see an impossibly smooth historical performance graph bragging about a 90 to 99% win rate, it doesn't mean the system is some predictive genius. Actually, quite the opposite. Studies analyzing thousands of algorithms show that heavily optimized past performance has an R-squared correlation, basically a statistical overlap, of less than 2.5% with actual future profitability. In short, a perfectly smooth backtest shares virtually zero statistical overlap with live market reality. No way around it. Section 3, the mathematical reality. Let's pull back the curtain for a second and look at the actual empirical baseline of the most successful, heavily capitalized trading operation in modern financial history. We need to see what a real edge looks like. Renaissance Technologies' Medallion Fund is pretty universally regarded as the greatest wealth-generating vehicle ever created. From 1988 all the way to 2018, they achieved an almost incomprehensible 66.1% average gross annual return. But here's the kicker. They didn't do it with a 90% win rate, not even close. They did it by processing between 150,000 and 300,000 automated trades a single day, systematically extracting these microscopic margins of just 0.01% to 0.05% per transaction. And here is the absolute mind-blowing reality check, straight from Robert Mercer, the fund's former co-CEO. He explicitly stated, "We're right 50.75% of the time, but we're 100% right 50.75% of the time. You can make billions that way." Think about that. The smartest quantitative analysts in the world, equipped with literal atomic clocks and supercomputers, operate at just a 50.75% accuracy rate. They rely entirely on the mathematical law of large numbers. Section 4, the power of 58%. This proves that long-term wealth isn't generated by an impossible win rate. It's generated by mathematical expectancy. That's the exact average monetary value you expect to return per trade. Let's look at the math on how a flawed, overfitted retail bot, winning 90% of the time, can actually have a negative expectancy. If it wins $100 on 90% of its trades, but because of terrible risk management, it loses $1,000 on the rare 10% of losing trades, the formula shows it is systematically draining your account by $10 every single time it trades. The quick dopamine hit of winning constantly is just masking a slow, painful bleed to zero. Now, conversely, look at the expectancy of a transparent model operating with just a 58% win rate, but using a strict 1-to-1 risk-to-reward ratio. That means your average win exactly equals your average loss, let's say $100. Because it is mathematically verified, it practically guarantees a positive expectancy of $16 per trade. Once you have a positive expectancy, profitability isn't about luck anymore. It becomes this pure, fascinating function of execution frequency and compounding over time. To scale that modest 58% edge into exponential wealth, these algorithms focus intensely on specific execution intervals. The 1-hour interval captures rapid intraday shifts, while the 4-hour is kind of the sweet spot that filters out all the chaotic market noise. But the 8-hour interval is profoundly significant. Why? Because it perfectly aligns with massive institutional capital rotations. This is exactly when big players regularly adjust and settle their massive perpetual futures positions on the major exchanges. So algorithms modeling this 8-hour window are effectively predicting the structural repositioning of huge institutional capital. And to survive extreme market volatility while compounding this edge, professional analysts deploy strict fractional capital allocation formulas. The most famous is the Kelly criterion. This formula basically calculates the exact optimal fraction of your account to risk per trade. By utilizing just a fraction of the Kelly suggestion, say risking only 4 to 8% per trade, analysts capture exponential compounding growth while mathematically suppressing severe drawdowns. It virtually eliminates the risk of total ruin. Now, this 58% threshold isn't just some theory we're throwing around. Recent, rigorous, peer-reviewed academic literature consistently shows that genuine, out-of-sample directional prediction for volatile assets like Bitcoin firmly maxes out in the mid to high 50s. Even the absolute most advanced machine learning models, like complex neural networks, hit around 54% to 58% accuracy. So any study or bot claiming 90% accuracy, it is almost always restricted to highly specific, isolated anomalies, or it's just severely overfitted to a tiny dataset. Section 5, the Explainable AI mandate. Because the sheer impossibility of that 99% win rate is becoming so obvious to everyone, the financial industry is shifting completely away from hypermarketed, opaque algorithms and moving toward verifiable transparency. We really have to contrast traditional black box models with explainable AI, or XAI. You see, a black box model optimizes for raw prediction at the total expense of interpretability. When the market regime suddenly changes from low volatility to high volatility, the black box suffers from catastrophic regime blindness. It executes outdated logic and causes massive drawdowns without ever explaining why. Explainable AI, however, provides transparent, auditable decision-making. It acts as a cognitive bridge between the machine's cold calculation and the human trader's actual context. Using specific post-hoc diagnostic tools, an explainable AI system explicitly reveals its internal logic to you. For example, if it outputs a prediction with a 58% statistical confidence, it doesn't just leave you guessing. It will explicitly tell you, hey, 40% of this decision was driven by order book imbalances, 35% by funding rate shifts, and 25% by moving average crossovers. It fully empowers you to manually validate the machine's logic before a single dollar of capital is ever risked. And here's the thing. This level of transparency is no longer just optional. Global regulators, including the European Union through their landmark AI Act, are classifying financial AI as high risk. They're effectively banning unsupervised black boxes and legally mandating interpretable logic in high-stakes finance. Global Tier 1 banks are already proactively integrating explainable AI just to ensure continuous auditability. As we wrap up this explainer, I really want to leave you with one vital question, a rule of thumb to protect your capital moving forward. Whenever someone hands you a beautifully charted, 99% accurate automated trading bot, ask yourself this: is it actually predicting tomorrow's market, or has it just perfectly memorized yesterday's noise? True wealth isn't built on the illusion of perfection, guys. It's built on the quiet, disciplined execution of a mathematically sound 58% edge. So which one are you going to trust with your money?